All right. Good morning, everyone. Welcome to Marketing Matters. I'm Sarah Touchstone, Landmark Title's social media marketing strategist and educator. I get the pleasure of bringing you all Marketing Matters live every Wednesday morning at 10 a.m. This month has been all about educating and preparing your buyers. We've covered a lot of great topics the month of February, and today's topic is no exception. This one is Pre-Qualification 101, what your buyers need for mortgage approval. This is, even though this is our third week, this really should be the step one, right? When
Yes.
you're working with your buyers. There's been so many changes recently to our real estate industry. And although going out with a buyer that has a prequal has always been a good idea and the right idea, sometimes we let things slide a little bit and we're like, okay, we're just going to go show these couple of houses. But now really is the time to make sure that all your T's are crossed, all your I's are dotted when you're working with your clients, particularly buyers now. So we've got Connie Moss on today to give us a great overview of how you can set up your clients for success and get those pre-quals done. So Connie, I'm going to hand it off to you. Connie's been on several times. She's a wonderful, wonderful guest speaker, and she's going to bring some amazing knowledge for us today.
Thank you so much, Sarah, and really good morning, everyone. Glad you're here on this Wednesday, beautiful morning. I'm really super excited to go over this topic because it's really step one, as Sarah indicated, for any buyers out there. Sarah, I was hoping I wanted to kind of go over the pre-qualification process and do the are you a renter or buyer, the other flyer.
Other one, get in there. There we go.
There we go. Okay. So many times, folks clients are not necessarily, they're just on the fence whether to buy or rent. And that's really agent's job to get them off the fence and that education there. And with this flyer, it kind of goes over, are you a renter or are you a potential buyer? And why buy? And so, these are most common sense reasons why to buy. Unlike rent payments, the interest you pay on your mortgage may be deductible. In most cases, it is. Where a person pays rent, it's not deductible. There's no benefit. It just goes out the window and they're paying for a place to stay. With mortgages, your mortgage payment stays the same where, unless it's a variable, most people have the fixed mortgage rates and products. And that means your monthly mortgage payment is going to be the same every month. Whereas rent, at the end of your lease, the landlord could increase your rent. And you don't have that necessarily with your mortgage payment. Another benefit to be a home buyer is that you have equity. Each time you make your monthly mortgage payment, it decreases your loan and equity builds on your house. And with that said, historically in Arizona, we have had about a 6% increase. There are different years where it's higher, different years where it's lower, but our home gains in value. So it's an asset. It's kind of like a checking or a savings account that has an interest. It's a where you put your money into a house and it builds an equity. So in the future, it's worth more than what you bought it for. In most cases, that's the way it's been. So that's super cool. And the fourth main reason is you can make your home what you want it to be. Whereas if you're renting, you have to ask the landlord, oh, can I paint the rooms a certain way? Can I change the landscaping? Can I add something? And the landlord may say no. And so it's not necessarily your home. You're just renting it to live in. So with that comes home buying. You have creative freedom to make this dream home or your home the way you want it to be. So, excuse me, those are the reasons I think people sit on the fence, and those benefits should be, brought out to the potential buyer so that they know, these are, or benefits to buying versus to rent. I just wanted to kind of recap that information. And then the second flyer, Sarah, the 10 tips, I'd like to go over that because that's the step before getting with a loan officer and pre-qualifying. Thank you so much. So these are 10 tips to know what people need to know. If they're in the market to buy a dream home, they have to keep these things in mind, these clients. Do they pay all their credit cards and any other debts on time? So that would be an indicator that they have good credit if they pay all their credit cards every month on time and any other debt on time without even pulling the credit as a loan officer, which is what we do. Part of the reasons in pre-qualifying people is that we need to make sure they have credit enough to buy a home. So if we know in advance they do pay their credit cards on time, or they say they do, that's a good indicator that they have good credit. The second factor is in their lifestyle. Will a lender give you a range that includes the top end of how much home you can afford? The numbers based off of your current expenses, not your future. So when we do jump into the pre-qualification process and go through debt ratio, and that will be after this flyer, a lot of people have misconceptions looking at homes, not understanding, what can I afford? Is that home that I see on, on the computer, what can is that home something I should even be looking at, first of all? So a lot of times people are unaware of what they can actually afford, and that's why pre-qualification is so important. Another thing that clients don't think about is when they're filling out an application with any particular loan officer, we want to make sure they don't omit or exaggerate any information just because, oh yeah, I have that much in the bank. A lot of times when people pre-fill something out online, and then we actually gather documentations is really not what they put online. So it's funny, people, oh yeah, I have great credit. And then when their credit's pulled, their credit is actually not great. So anyway, just, keeping those clients informed, hey, don't exaggerate anything. Just be honest and truthful with it.
We did have a
Another-
question a couple
yes,
minutes ago about the 6% equity increases
yes.
per year.
For a gain in house value, the gain in house value can fluctuate, and it can be any, historically, we always say about 6% gain. I'm not exactly, to answer that question, I'm not exactly sure if it's per year or how that's calculated, but that's, what we have gone with, saying, hey, if you buy your home for 200,000 in 1 year, it's gonna be, 206,000, or what, it
Yeah.
is, I would say per year. That's historically what we have in a stable market.
Yeah, it seems like it may vary a little bit from
Yes.
year to year based on the market.
Yes, I
But
agree. I
yeah, we
agree.
always kind of go with
In a stable
average
market.
estimations.
Yes. Yeah, I agree with you. Um, So the step number 4, don't buy a vehicle, even if you're paying cash. If a client is in the process of really being serious about getting pre-qualified to buy a home, it's important. Vehicle is a big expense, and they think, oh, I'll just use cash to buy it. Well, then that's taking away cash from possibly money for down payment or reserves, and those things I'm going to go over in the after this flyer. But if they use up cash, that cash might have been better left in their bank to cushion for this home purchase or part of their down payment or the reserves needed when they buy a home. So that's why we tell people, hey, if you're in the market to buy a home, don't buy a car right now. Okay. So if you need to buy a car, buy it now, but consult with your financial advisor or your loan officer that you're working with and have them look at your information to make sure that utilizing that cash to buy a car or adding a car payment in your credit on your debt is going to affect whether you can buy a home or not. Okay. So that's important things people don't really think about when they're going to buy a home. Providing documentation your loan originator asks for in a timely manner. if your client is possible sitting on the fence thinking, I really want to own a home. I really think this is the time for me to buy. Giving the documentation to the loan originator in a timely fashion is important because things change. A person's credit can change from 1 month to another. So if the loan originator asks for pay stubs so they can generate how much income they make, if the borrower gives one pay stub and then a month passes and gives another, there's probably a gap of the first pay stub and the last one. They could have gotten an increase in their pay. They could have changed the way they're paid. So just by giving it all at one time allows the loan originator to best look at their scenario and be able to pre-qualify that client instead of dragging it out over time. Okay. Step 6, it says, do you keep your money right where it is? Changing banks or moving money will require explanation. To explain that, sometimes your borrowers have more than one bank. They might have Chase Bank and they might have MidFirst. They keep money in one and keep money in the other. If they are kind of in some people, when we talk to them, they tell you up front, but in the gathering phase, when I gather information from potential clients to pre-qualify them, I ask about their assets. And so if they have more than one bank, if they tend to, I'm going to open another bank with Chase or Bank of America, so now they have 3 different accounts. That makes it hard because it's jumping the assets around, especially if they move it from one to the other. When we look at pre-qualifying a client, it's fine if they have multiple assets or bank accounts, but we usually get a 2-month depth of those accounts. So as of, like the most recent 2 months, and that way we're using that as their assets. And if they keep opening new bank accounts with different creditors, then we're never going to have the 2 months of built up with that one creditor before they've moved to another. We can, because we take the one from one, but it's a little more complicated. It's easier if they just keep their money that they're going to use for the down payment into one account. So, so that's to explain number 6 about not moving money around, keeping it in one spot. Like, this is my house fund. If they're saving up for that down payment, put it in a savings, leave it alone, don't touch it, let it grow instead of moving it all over the place. It makes it a lot easier for your loan officer. Okay. Step 7, do explore mortgage options. It's kind of like gas prices. There's different gas stations and they're all a couple pennies different from each other. Loan origination is the same. From one bank to the other, we basically have the same products. If one bank was lending with, I'll say, a 3% interest rate, and the regular rate is 6%, there would be a huge line in front of that bank with 3%. Okay, so where I'm going with this is from one lender to another, we basically have the same interest rates. So there's different products though. It's kind of like being at a restaurant where they have multiple things on the menu. Banks have a rate, but they have multiple products to choose from, and that you will be able to hear in a different presentation, I believe, coming forward after mine. So, so that is just to explore all of the products that are out there. Okay, so that you know your mortgage options. Don't take on any new debt. Sometimes these potential buyers that are looking to pre-qualify to buy their dream home don't realize that buying furniture or taking on jewelry or whatever, you're adding more debt to your debt ratio. And that makes it difficult when you're buying a home or qualifying for how much home you can buy, because we have to account for all the current monthly debt that you currently have and add your mortgage payment on top of it. So the more debt you incur, the less home you'll be able to buy. So that's why we kind of say, don't take on new debt, just leave your debt the way it is. If you need to buy something or get something and you're in the process of looking for homes because you've been pre-qualified or are going through the pre-qualification process, consult your loan officer. That person should be able to let you know, hey, if you're buying that ring to be engaged, that's going to put on that monthly payment of such and such. that will not affect you or that will affect you. It has to be an open conversation with trust, and we're there as lenders for the best interests of the client. We want the client to take on something that they can afford. And if it's their dream home, taking on new debt may pull them out of finding their.
Connie, I'm not sure if it's on my end, but I can't hear you. I'm going to try and adjust my sound. Okay, yeah, Connie, no, nobody can hear you. I don't know if you can hear us. Zoom is always so fun. Let me send her a text message, guys. All right, but you guys can hear me, right? All right. Okay. Let me try and get a hold of Connie.
To
There it goes. Connie, we couldn't hear you for a second.
Yeah,
Now we can.
something wasn't working and then the mouse was moving by itself on here. So is everything back
Yes.
for me?
Okay.
Can
There
hear
we
me?
go.
Okay, so I don't know where it cut out. Sorry about that, folks. It was just some technical craziness there. Um, so we were talking about not taking on any new debt. And then I was going into do check your credit score to help you determine financing options. Most people.
Uh-oh. Connie sounds out again. Yep.
Okay.
There it is.
So is it working again?
Yes.
Okay. So anyway, so most people are aware of their credit, and they may not know their credit scores, but they are aware that they have either bad credit or good credit or fair credit. So it's for your client, I always say make sure you are somewhat aware of your credit before going into this process. There are free FICO checks that they can do, or wherever they bank with checking or savings. That oftentimes you can go to, let's say you bank with Wells Fargo saying, hey, I'd like to know what I have as a credit score right now. So knowing just some vague idea of what your credit is like is helpful. Okay. And then finally, do make sure you know what home you want and where you want to live geographically. Okay. So getting pre-qualified, you have to have some idea. Just like I want to live in Phoenix. Well, where in Phoenix? North, south, east, west. You have to have some idea. Do you have kids? Are they wanting to stay in certain school systems? So that will be something that helps out determining home buying, how much you can qualify for, because there's different areas of our great state of Arizona that are more expensive to live in. And so the home prices are higher or lower in different cities. So those are just some general things for people that are thinking of buying a home before they get pre-qualified to consider. So with that said, I want to talk about the pre-qualification 101 as lenders, what we ask for clients that say we're ready to buy a home. Okay. The first part in thinking of buying a home, there's four main aspects that we look at: credit, employment, assets, and current housing. Those are the four main things that we talk to someone when they call and say, you know, I really want to buy a home. I need to get pre-qualified. My realtor said that's the first step, which is true. So you know you're not wasting anyone's time and that you can actually buy this home. Okay. So credit, if they have a vague idea, then they'll know that they pretty much have pretty good credit or fair credit or poor credit. They'll let you know. But with credit, we have three credit scores. We have TransUnion, we have Equifax, and we have Experian. As lenders, we use whatever is the middle number of those three. Okay. It's not an averaging system. I've often had people say, what do you mean middle number? So if I pull credit, a tri-merge on a borrower to see what their credit is like, it's going to populate their liabilities and it's going to give credit scores. So TransUnion might be 700, Equifax might be 720, and Experian might be 740. 720 is the credit score that I use to grade the rate off of. Okay, so that's what I mean by the middle score. Whatever that middle number is, that's what drives their interest rate. So we talk to people, hey, are you familiar with your credit? Do you know your credit scoring? They'll throw a number out there, and that's fine. But when we get more serious about it, and we pull credit, then we'll know what their middle score is. The credit is going to populate all assets that report to the bureaus. Rent doesn't usually report to the bureaus. Cell phone usually doesn't report to the bureaus. So there's certain things that don't report to the credit bureaus, but what does report, like automobile loans, education loans, credit cards, those things are counted in the debt ratio. So whatever the person makes for income and then their debt, that comes into play with each other. So credit is the first one we talk about. Someone says they have a 400 credit score. There's no loan for a 400 credit score, traditionally lending. Maybe they could do private money lending. That interest rate is super high. But credit score, historically, most loans need a 580 or above. The higher the credit score, the better the interest rate. Just sharing that with you. The second part I mentioned about pre-qualification 101 is employment. We look at 2 years worth of employment. So if a person says, I just got a job and I had a big break because medical reasons, or I've never worked at all and I just started my first job and I've been on it for 3 months, that would be a little difficult to get qualified to buy a home. We look at a 2-year work history, going today backwards. So if a person has been on, it doesn't have to be the same job, but a job doesn't necessarily have to be in the same field, but they need to have W-2s or some type of employment history from today going backwards for 2 years. Okay. And we can use education. If someone's a nurse, she was going through nursing school, she just graduated 2 months ago, she got her job at a hospital, we can count that 2 years of employment using her education as a job, even though she wasn't paid. Okay. But it was education for the field that she's in. So these are questions you can ask a loan officer more in depth with, but employment, we need a 2-year work history. Okay. So that is the second main point. The third point I talked about is assets. Assets for money for down payment. I always ask people about those two factors. And when I get to the third one, do you have money for down payment? Where is it kept? Is it in a retirement account? Is it money market? Is it in a checking or savings? If it's cash in your safe, then that's a different story because we need to get that deposited in a regulated institution, like a checking or savings or somewhere that we can get a statement from. Cash is not trackable. We have to have a 2-month history. So if somebody is putting 20% down on a home, they have 100,000, but they have cash under their mattress. I can't show the underwriter that there's pictures of all these cash. Where has it been? Did they rob a bank? Did they win the lottery? We usually need 2 months of the cash being somewhere sitting for it to be seasoned. Otherwise, the lender underwriter is going to ask us to source and season where that money came from, and we cannot season cash unless a person sold a boat or something big that they got the cash for, and we could paper trail that. So assets, money for down payment needs to be somewhere for 2 months. It needs to be seasoned for 2 months. for it to count. Okay, so that's very important when someone's wanting to get pre-qualified. Do they have their money for down payment? How long have they had it for? So if it's going to be a gift, that's something completely different. They don't have to have gotten the gift for 2 months. The gift is we can paper trail. Okay. The last area is their current housing. Do they live at home? Are they renting? Do they own a home now? Then they're just buying another home. So we need a 2-year history of housing. So that's why I always ask people that are getting pre-qualified, hey, if it's fine if you lived at home rent free, no big deal. I just need to know where you've lived for 2 years, going from today backwards. Okay. So those are the 4 main pieces that we look at to get pre-qualified to buy a home for clients that have already made that decision. Hey, I want to make the effort to buy a home. I feel I'm in a position and I'm ready to go. Then we have to evaluate their credit. We have to evaluate their employment. We have to evaluate the money for down payment and their current housing. When we have that information, we can actually pull credit and put a file together that puts all their income, puts all their assets, and it allows us to see the debt ratio, is what we call debt ratio. That means the income versus the debt. We can plug in an example house price, let's say 400,000 house. We plug in a current interest rate based off of the client's credit score, the middle score. We'll now be able to calculate their exact rate, to calculate their payment. And with that payment, we can decide, yes, you do qualify for 400,000, but your income says you can actually qualify for 450 or 500. So educating the potential buyer about the things needed for pre-qualifying with regards to credit, we pull the credit. So that's that. Employment, they would need to supply 30 days of pay stubs. So if they're W-2, 30 days of pay stubs. So sometimes if they're paid weekly, that's 4, biweekly, I need two most recent pay stubs. That will adequately allow me to calculate their income. W-2s, generally the most recent 1 year W-2 is sufficient, plus the 30 days of pay stubs. That will allow us to calculate the income for a regular W-2 individual. If the person is self-employed, we go off of filed tax returns. So historically, we need 2 years of filed tax returns. We need the most recent year and the year before that. So whatever the client pays to the IRS on taxes, which is the net number, that's what we use to calculate their income with. So with a self-employed borrower, I usually talk to them and say, hey, how many years have you been self-employed? On paper. Sometimes they, oh, I've been doing this for 20 years on paper. So, I mean, we can go into the Arizona Corporation Commission and look up, an S corporation, if they have any type of, a C Corp, S Corp, LLC. A sole proprietor, you just need to use the tax returns. But 2 years self-employed on paper is what's needed to utilize self-employed income, and 2 years of tax returns. So depending on when they started to be self-employed, what month that fell into the year. So 2 years of tax returns on the net. If the most recent year is a loss and the year before that was higher, we just have to use the loss to calculate their income. So if the most recent year is greater and the year before was lower, we actually use those 2 years and average it out. So if, for example, whatever the net number is, if it's 60,000 for the most recent year, and the previous year it was 50,000, we take 50,000 plus 60,000, add them together and divide by 24 months. And that's what their monthly income is. Okay. A lot of people that are self-employed think it's, oh, I make $1 million a year. That might be gross, but after they write off everything, it's that net number at the bottom that they pay taxes on. That's what the underwriters use for income, for utilizing tax return for income. There's other programs which I'm not going to get into because I'm here talking about pre-qualification, but there's bank statement programs. If their tax returns don't show that they make a lot of income, your loan officer probably has a bank statement program, and we don't have to use tax returns. We use a bank statement program, and that would be going over deposits and utilizing that for income. So for the qualifying of people that are self-employed, 2 years of tax returns and calculating the net, okay, on that. With regards to assets, I indicated a little bit earlier, we need 2 months of assets. So these would be 2 monthly bank statements, most recent consecutive bank statements, and of all accounts. And then any retirement accounts, with buying a new home, a lot of people don't know there's money for down payment and closing costs, but there's also reserves. Reserves means that when someone's buying a home, they need at least 2 months or 3 months of that monthly payment in what we call reserves. So if the house payment is going to be $2,500, then they need 5,000 in a bank account on top of the money for down payment and closing costs. So in addition, they need that extra 5,000. The 5,000 isn't going anywhere. It's not going to be given to anyone. It's just showing that they're cushioned in case they were to lose their job or something happens. They have 2 months worth of house payments sitting somewhere. So oftentimes retirement accounts can be used for reserves because historically people are not drawing out from their retirement to put down on a house. They usually have checking or savings or something that's more liquid. I can use the retirement for reserves. So that's with the assets, why we gather 2 months, just to show that the money has been sitting there and they're ready to put that down. So that's a big part of qualifying people, is making sure they have the down payment, because otherwise you're just window shopping without money in your pocket. And nobody likes to do that. So those are, I think, the most important tips with regards to getting qualified or having those folks qualified. They would need to be prepared to show their income, to discuss, their housing the last 2 years, for their money for down payment. Where is that coming from? Is it, in an institution? Because if it's cash, they need to deposit it right away because it needs to be somewhere, sitting in an account that has had 2 monthly statements worth. So if the client is sitting on the fence saying, I have all this cash, but I want to buy a home in the spring, you're like, well, put the money in now so it can be seasoned for 2 months. So it'll make it a heck of a lot easier for your loan officer to source or season where this comes from. So, and then just understanding, we need to be under 50% debt ratio. So that house payment plus all your credit cards, automobile, student loans, whatever else that reports on the credit report, your income, and that debt and new house payment, it has to be 50% of what you make. And then a lot of times in pre-qualifying someone, they might be able to qualify for more than really what they want the payment to be. So what I'm meaning is they make really good income, but they want to keep their payment at 2,500. The loan officer can advise, hey, you really qualify for more of a home than what you were talking about, but your payment's it's appropriate to your payment. So sometimes people go, oh, I want a $2,500 payment, but I want $1 million home. Well, if you have $1 million home and you're only putting 20% down, so your loan is 800,000, you're not going to have a payment of 2,500. The payment is going to be appropriate to the loan size. Okay. So that I always have to educate people, or I try to educate people, whatever home size you're looking at, that payment is going to be appropriate to it. Okay. It just makes sense, common sense. So are there any questions, Sarah, you can think of that, that I haven't touched on?
One of the questions that was brought up with making sure that you've got everything ready is the insurance cost as well.
Okay.
So how
Yes.
how can we,
That's yes. I really like that question. Thank you so much for asking it. When people buy a home, they're going to have homeowners insurance. It's just what you need to have in case there's a fire or the home burns down. The homeowners insurance, might be State Farm or Farmers or whoever a person might use for auto, but a person can get a quote from their current homeowners insurance I mean, not homeowners, their current insurance on on their auto. Say, hey, I'm thinking of buying a home. Are you able to give me a quote on what homeowners insurance might be for a $400,000 house? You might be able to get some ideas of costs. The loan officers usually know, because we've been doing this for a while, that an estimation of a homeowner's insurance might be, $1,000 for the year for a $700,000 house. So we will be able to give some advice on how much it is for the year and divide that by 12, and that would be the monthly expense. When we pre-qualify someone, we do the taxes and insurance included in the mortgage payment. So when we say your mortgage payment is going to be 2,500, I'm just using that for example, then that includes the taxes and insurance. That way we're not forgetting those, because those are a part of the debt ratio.
Awesome.
Mm-hmm.
Guys, do you have any other questions for Connie? And her contact information is on this flyer right here as well. Connie,
Thank
would you
you.
go ahead and put it in the chat too?
Sure.
Sometimes it's easier for people to just go in the chat and copy
Yes.
and paste that. Um, but if you guys are on live, so you do have the opportunity to ask questions. Let me check all of our. All right, we do have a question. In our question and answer window, would child support count as income if it shows the income payments are not consistent monthly?
Um, That's a good question. Child support can, yes, be counted for income as long as a person is going to be, if the child is of age where that child support will be received for 3 years. So we are able to count things as income if that income is going to be able to be there for 3 years from the note date of this new home that we're buying. So if the child is 6, most likely they get child support till they're 18. There's obviously 3 years there. But if the child is 17, they're probably, we can't count that as income because they're going to be 18 in a year.
Yeah.
So if it's inconsistent, usually child support is consistent, meaning like there's a decree and the decree says what that amount is. That's what we use to calculate the income, is whatever's on the decree, child support decree. But we also, hopefully, the person that's paying the child support is paying the full amount. So that can be tricky if they're not, and that would be an underwriter question. The loan officer would have to give the underwriter. But historically, we use what's on the decree and just plug that in for the income.
Nice. Yeah. And I imagine if you're getting, like, if you've worked out child support outside of a divorce decree, that might be kind of hard to include
That totally would be hard.
the
It
income.
needs to be in writing to be able to be counted.
Nice.
So
That was a great
if it's not in
question.
writing, then it's there's no proof that it's going to continue. It could be spotty, and there's no court order that says it will be there.
Yeah. Well, that was a great question, Van.
It
Thank
was a great question.
Yeah. I'd never even thought about that, but sometimes you are getting, a regular chunk of money, and that's a great thing to know to include on that as well.
For sure.
All right, let's see. I think that is it. But like I said, if you guys have any questions, please let us know. Reach out to Connie. She's
Mhm.
going to put her contact information in the chat as well. Or if you think of anything as I am wrapping up, I'll double check before we are done today. Or if you'd like a copy of these flyers, please reach out to Connie. She can get these over to you very easily.
I want just one real quick thing. Since you brought up the child support, another thing people don't know about is people on fixed income that are retired. That counts. Social Security, most people are aware. So Social Security and pension, that does count for income. So if they're retired and they get fixed income that way, that's just like, we calculate that as income for sure. And then there's also assets for income. If some people are retired, but they're retired at a younger age, that they're not collecting Social Security. I've had this come up before, but they do have like $2 million in assets and they just take a draw from that yearly. We are able to use that for income. So those
Awesome.
things we are able to use for income. Just wanted to
Awesome.
share with
Yeah.
you, other than W-2 or self-employed.
That's really, yeah, that is really good to know because there are,
That might in the
we
chat.
especially Social
Right.
Security and
Return.
child support. Those are
Yes.
are definitely categories that you probably will run into more often than not here in Arizona. So great points. All right, guys, I'm going to wrap up with other classes that we have coming up this month. We are finishing out our Mastering the Path to Homeownership series with the different types of mortgages. So FHA, VA, USDA, and conventional. And we're going to explain and break all of that down next week. Whether you are familiar with all of these different types of mortgages, or you're like, I'm familiar with a couple of them, hop on. You're always going to get a good nugget of information on these Marketing Matters webinars. And that's going to wrap up our home buyers next month. And then tomorrow, up in our Prescott office, we are doing the buyer broker agreement. It's kind of like a mastermind, really, and real world application strategies. I had the pleasure of talking with our rep up there, Raylan, yesterday, and she is going to be doing a series of industry-led events. So we've got, for this one, we've got Josh Rice with the Rockstar Group. He is a top producer up in the Prescott area. And so this is a really interesting take because these are the people that are the leaders in the industry up in the Prescott area, and you're going to be hearing directly from them. So that is tomorrow from 3 to 5 at Founding Fathers. Woo, got a little caught up there. And we're going to have some appetizers and little snacks. So you can't go wrong getting fed, right? So reach out to Raylan if you want to attend that tomorrow. And then the following week, I will be up there in the Prescott office. We're going to be talking about Chat GPT, which is literally, this is my best friend when it comes to everything and anything I do in my life. I call it my personal assistant because it is something I utilize multiple times a day. It has been honed in to, not only do I use it to produce content, but I use it to plan my children's birthday parties, vacations, travel. It knows me better sometimes than I know myself. So this is a great tool for building efficiency as well. And I'm going to show you how you can use it to create so much content for your business quick and easily. This is next Thursday, February 27th at 1 p.m. All right. And then we've got the Broker Open. This is a big one down in Gilbert. Patty is hosting this. This is going to be an amazing luxury property. You can just kind of gaze at some of those pictures up there. A very unique house. If you guys are in the East Valley, go out, check it out on the 27th. This is from 3 to 7 p.m. And if you're not in, the East Valley area, maybe just take a trip out there. It'll be worth your time. And then, of course, every month we have our 2 home tours, Moon Valley, third Thursdays at 8:30. That is, I think that is tomorrow. Yeah, I'm looking at my calendar. I'm like, third Thursdays. That's tomorrow, the 20th. And then we have our Biltmore Luxury Tour, and that is on the 4th Wednesday. So this one's going to be next week on February 26th. That's at 9 a.m. Great ones to attend. If you ever have a home in the area, reach out. We can get you on these tours. And then, of course, if you miss any of the classes on Marketing Matters, you miss Marketing Matters, you're like, hey, what is Landmark offering this month? Go check out our events page on our website for the most up-to-date offerings. And that's it for us today, guys. So, of course, thank you to Connie for coming out. Thank you for our business development managers for inviting you guys and helping you with all of your marketing needs. Beth, Keith, Mary, Michael, Patty, Renee, Raylan up in Prescott. If you're not already working with one of them, please reach out. And of course, reach out to us for all of your title and escrow needs. We have 7 offices across the valley, 1 in Prescott, 2 up in Nevada, and we are here to help with just about everything in your real estate business. We are your partners. So once again, thank you guys for attending. Connie, thanks so much for coming out today. This was great information.
Thank you very much. My pleasure, and happy to be here.
Absolutely. Thank you. We'll have to have you back on again, Connie. It's always a pleasure.
Yes. Thank you so much. Looking forward to it.